Apple is valued at approximately $4.9 trillion. To justify that price, our reverse DCF says free cash flow must grow by approximately 14.1% per year, every year, for the next 10 years. That is more than the company has delivered in its recent history. Can Apple actually sustain that, or is the price already assuming perfection? To answer that, we test the valuation in 3 ways. A reverse DCF reveals what the current price already assumes. A traditional DCF estimates what the business could be worth under bear, base, and bull scenarios. An evaluation multiple shows how expensive the stock is relative to earnings and its own history. 3 tests, 1 verdict. Before valuing Apple, we need to understand what actually produces the cash flow. Apple's engine is its installed base, devices in daily use that buy the next device and increasingly pay for services on top. Premium hardware plus high-margin services, that mix is what becomes free cash flow. The defense is the ecosystem. Devices, software, and services work best together, so leaving means replacing everything at once, and that keeps the base loyal and the pricing premium. That also means the valuation depends on the installed base has to stay loyal, and replacement cycles cannot keep stretching indefinitely, on whether services revenue per active device has to keep rising without triggering regulatory or customer resistance, and on whether premium pricing and a favorable product and services mix have to protect the margin as hardware markets mature. Apple's recent performance explains why investors pay the current price. Over the last 3 years, revenue has grown at approximately 1.8% per year, earnings per share at approximately 6.9%, and free cash flow at approximately minus 3.9%. Over the same period, free cash flow margins have moved from 28.3% to approximately 23.7%. The most recent quarter adds nuance. Revenue grew 16.6% year over year, a clear acceleration from its recent trend. The question is whether that continues. You can see it on the chart. While the broader market compounded quietly, the stock ran far ahead of it. That run is the reason for the premium. But recent growth is the starting point of this analysis, not the forecast. The question is never what was delivered. It is what the price now requires. At the time of this analysis, Apple trades at approximately $334 per share for an equity value of roughly $4.9 trillion. Trailing free cash flow is approximately $129 billion. A traditional DCF starts with forecasts and calculates a value. A reverse DCF does the opposite. It starts with the current market value and solves for the growth rate that makes the price mathematically possible. We use a discount rate of 9%, terminal growth of 2.5%, and the company's current free cash flow base. The result, the market is pricing in approximately 14.1% annual free cash flow growth over the next 10 years. That growth path takes free cash flow from $129 billion today to approximately $484 billion in year 10, 3.7 times the current level. Watch it compound year by year. Year 1 already needs roughly $147 billion, by year 5 approximately $250 billion, and by year 10, $484 billion, each year building on the last, with no year off. That target has operational consequences. At a long-term free cash flow margin of 23.7%, Apple would need approximately $2 trillion in annual revenue by year 10. The market is not pricing in one more strong year. It is pricing in 10 years of sustained delivery, but does our own forecast produce the same value? The reverse DCF tells us what the market requires. Our traditional DCF tests whether a reasonable forecast produces a similar value. In the base case, recent growth has been weak, so we start at approximately 2% and let it recover only to 4%. A mature steady state, not a comeback story. We assume a mature free cash flow margin of approximately 23.7%, a discount rate of 9%, and terminal growth of 2.5%. Under these assumptions, our base case value is approximately $143 per share. In the bear case, growth fades early toward 1.1% and margins come under pressure, that is worth approximately $120. And in the bull case, 2.7% growth with almost everything going right, the value reaches approximately $162. Bear, base, bull, that is our honest range. Now watch where the current price lands. With the stock at $334, the price sits above even our bull case. The DCF gives us a value, The multiple tells us what investors are paying for it right now. Our final test is the valuation multiple. Apple trades at approximately 41 times trailing earnings. Based on expected forward earnings, that falls to approximately 35 times. The gap reflects the growth analysts already expect. The company's own 5-year median is approximately 31 times. The broader market trades at approximately 24 times. Think of a multiple as patience, 41 times of price for every unit of current earnings. A high multiple is not automatic evidence of overvaluation. The question is whether earnings can grow fast enough to justify it, and that is exactly what the DCF already measured. The valuation survives mathematically, but only if a few conditions keep holding. So what has to go right? First, the installed base has to stay loyal, and replacement cycles cannot keep stretching indefinitely. Second, services revenue per active device has to keep rising without triggering regulatory or customer resistance. Third, premium pricing and a favorable product and services mix have to protect the margin as hardware markets mature. And finally, Apple must execute consistently. The current valuation does not depend on one strong quarter. It depends on repeated delivery year after year. Picture 10 boxes, one for each year. The price has already checked every one of them in advance. The company still has to earn the check marks. The valuation can fail in several ways. Devices keep getting good enough to keep. Every extra month users hold on to their hardware pulls unit growth below the modeled path. The highest margin revenue, app stores, default placements, subscriptions, is exactly where regulators and rivals push hardest. Every concession lands on the margin. Hardware demand is discretionary and concentrated in a few large markets. One weak cycle in one of them stalls the compounding the price assumes. And higher interest rates would reduce the present value of distant cash flows, even if the business itself keeps performing. These risks do not need to destroy the business. They only need to produce results below what the current price already requires. Apple passes some of these tests. The final question is whether it passes all three. 3 tests. Here's the verdict. Test 1, the reverse DCF. The price demands 14.1% growth every year for 10 years. Growth well above what the company recently delivered. Test 2, our own DCF, $120 in the bear case, $143 in the base case, $162 in the bull case, and the current price sits above even our bull case. Test 3, the multiple, a clear premium to its own 5-year median. Add the 3 together and the pattern is hard to ignore. Even our most optimistic scenario cannot reach today's price. Our base case sits roughly 57.2% below it. One test flagging a stock can be noise. 3 tests pointing the same way is a message. This price already contains a nearly flawless decade. Our overall verdict, priced beyond our bull case. Apple remains one of the most profitable consumer franchises ever built. But a great business is not automatically a great investment at every price. This analysis is a valuation framework, not financial advice. The result depends on the assumptions shown, and you should always verify them and do your own research.